Well, here's a question. When was the last time you took a look at strategies to minimize the amount of taxes that you're paying before you actually ended up filing your tax returns? I recently met with Sarah this year, and Sarah was donating about $10,000 a year every year to her charity. What she was doing is, like most people, is she was just donating directly from her checking account, making contributions on a monthly basis to the charity that she had. She's retired. She's in her 70s, so she's taking money out of her retirement account, also being forced to take a required minimum distribution. She would then pay the taxes on it. The money goes into her checking account. She's writing out that money to the charity every month, making those donations. She literally had no idea that one simple tax strategy could save her over $3,000 a year. So back to my question, when was the last time you looked for ways to save money on taxes before filing them? You know, if your answer is really never, I just hand my stuff to the tax preparer, you're not alone, but you could be leaving thousands of dollars on the table every single year. And that's really why I created the company Retirement Tax Partners. I believe that taxes is not just a one conversation meeting, meaning that most people just meet with their accountant once a year. They get their taxes filed accurately and on time, and then they put their taxes away. And oftentimes they say, well, if I got a refund, then taxes are good. But I believe that the tax conversation really needs to be a two-conversation meeting. One, not only filing your taxes accurately and on time, but number two, getting back together on an annual basis with the accountant or CPA and running a tax what-if analysis. So whether you end up working with us and our team at Retirement Tax Partners, or take this knowledge and schedule a meeting with your CPA or accountant, because I'm going to show you why doing this is critical every single year and why just filing your taxes is not nearly enough. When you think about it, again, most people think about taxes as a one-time type of an occurrence, right? Whether you're gathering your W-2s, your 1099s, your tax and investment statements, and you give them to the accountant, or maybe you're even plugging them in, doing yourself through TurboTax or some other software. The problem is filing your taxes is backward looking. It's just reporting really what happened last year. And by the time you figure it out and file it, your opportunities to reduce your tax bill, for many cases, are really gone when, December 31st passes every single year. And the IRS is not going to send you a letter that says, hey, you could have converted $5,000 over to a Roth IRA or donated to charity differently. That's up to you to figure it out, and it's up to who you work with to help figure it out as well. So what I recommend that you do is I recommend that you get what is called a tax what-if analysis. And, again, think about it as a different game plan, really, from the start of the year. We're going to take your real numbers. We're going to look at your tax return. We're going to look at your income, what your deductions were, how much you paid in dividends and interest, maybe required minimum distributions, Social Security. And then we're going to look at, what's going to be different this year. We're going to run different scenarios to kind of help you figure it out. We're going to look at things like how much could you potentially convert over to, say, a tax-free Roth IRA? How much could you do this year? How can you do it over, say, the next 4 years under the big beautiful bill, and where the retirees have a little bit more room with where their deductions are at as well? Maybe, the changes to charitable giving. What if you bunch your deductions together in 1 year? What if you sold an investment now versus later? What do you look at when you look at things like your capital gains or capital losses and do end of the year tax planning? Should you move some of your taxable income to a tax deferred category or a potentially tax-free category? It's those forward-looking things that shows you how choices today can minimize the amount of taxes that you're going to pay this year and also every year in the future. And the key is, don't just do this once. I want you to do it every single year. Again, whether you're working with us or whether you're working with a CPA or accountant, I want you to have a two-conversation meeting. One, get your taxes done accurately and on time. But two, every year take a look at what the tax law changes are. This year is a perfect example, right? The big, beautiful bill is effective July 4th this year. Do you know, and have you run that tax what-if analysis that says, how do those tax law changes apply to our situation? We just just had a couple that came in. We ran a tax what if analysis, and they had found out that they had the ability to do more Roth conversions this year, and it would still keep them in a lower tax bracket because of the changes of the big, beautiful bill. Now, if they waited until next year when they met with their CPA and maybe met with them in March or April to file their taxes, that Roth conversion opportunity was already too late. They had missed out on that opportunity. So when we look at these major tax laws like what we have today, it's important to know how that applies to your situation. The next thing is life changes, right? Maybe you retired, maybe you're selling a business, maybe you're selling a stock, you started Social Security, you're looking to transition over into Medicare. Maybe you're now trying to navigate what required minimum distributions. Each stage is a different tax picture, and different decisions could be made along the way. The markets change as well. I mean, you've got gains, you've got losses, interest rates change where there's different opportunities, or there's risk every single year. So by doing this annually, it's going to allow you to stay ahead of the changes instead of reacting after the fact. Let me give you a couple of real-world examples of what I saw from Retirement Tax Partners this year. I've seen retirees really save tens of thousands of dollars over their lifetime by converting while they're in the lower tax bracket before required minimum distributions met in. We met with one client, and their income was so low they actually weren't paying any taxes. So that sounds great, right? Their income after deductions was so low. The problem was, at some point in the future, they may not pay zero taxes, right? Tax rates could change for them in the future. In addition to that, I asked them the question. I said, well, are your children paying no taxes? And they're like, no, our kids are doing great. You know, they're kind of at the best point of their life. And so the likelihood is if you leave that money over to them and they inherit that money from your retirement account, you realize they're not going to pay 0% in taxes. They had an opportunity where they could convert money over to a Roth IRA and still be able to say at a 0% tax bracket, or could even do it and stay at a low tax bracket, systematically shifting that money over. So if tax rates change for them on the future, they've already got that money over into the tax-free category. And or if they left that money to their children or loved ones in the future, that they would inherit it tax-free as well in the Roth account versus a fully taxable, tax-deferred traditional IRA. The example of the charitable gifting that we saw in the past, you know, the lady we had talked about, she could have used a strategy called qualified charitable distributions, and she could have donated directly because of her age out of her retirement account to the charity versus having that show up on her taxes. And ultimately, that would have saved her over $3,000 a year of taxes that she was paying. We saw another example of somebody who had sold stock in their investments, and, you know, number one, their stocks have been doing great and the market's been doing great, so profits are a good thing. But looking at the end of the year planning, developing a strategy, maybe there was some losers that they could have sold to offset some of the gains that they had, and that capital gain planning should have been part of their overall plan. Unfortunately, again, in their old system, their financial advisor never really talked to their accountant, so those two people never really communicated. They simply just reported history when they took that information to their accountant. Business owners, I mean, we look at business owners and business owner planning, you know, deductions, depreciations, restructuring your business, changing it maybe from a pass-through LLC to a corporation can make a big difference. I know I worked with my CPA this year with some of the businesses that I own. I worked with my CPA last year on the businesses, and we did some restructuring as well. And I can tell you that it saved a tremendous amount of money in taxes as well. So that what-if analysis is going to give you a side-by-side comparison so you can see in black and white what those changes look like. And the good news is if you do it now, you know, as we're, you know, kind of transitioning towards the end of the year getting here, and it'll be here quicker than you know, it gives you time to make some smart, intelligent decisions. And doing nothing can be expensive. If you just file your taxes every year without planning and you think, I got a refund, so taxes are good, you could still be really overpaying the IRS year after year after year. And the most common is paying taxes on money that you're not using. That's what I call voluntary taxation, and that's taxes that you pay on things like dividends and interest income. This is why asset location makes sense. Where you hold your investments, assets make a big difference. You could trigger Medicare excess premiums if you did things like pay off your mortgage or made more income. You can end up paying taxes on your Social Security benefit. And worst of all, you can miss that opportunity before the end of the year, before it expires. Things like doing that Roth conversion before the window expires every year at the end of the year with your tax rates and, you know, potential tax rates going higher higher in the future. So the cost of not planning over time can be a huge missed opportunity. Think about what that opportunity can mean to you over a traditional 10, 20, 30-year retirement time. It can mean hundreds, thousands, maybe even hundreds of thousands of dollars over the course of your lifetime. So here's what I want you to do. I want you to call your current accountant or CPA, and I want you to have that second conversation. And I want you to schedule a time to say, hey, I want to take a look at what can we do this year to minimize the amount of taxes I'm going to pay this year, and or any ideas or suggestions on what can be done in the future. The second option is you can get a hold of us. We can talk and connect you with our team at Retirement Tax Partners. We can do a what if tax analysis for you. We can show you in black and white. So, even if you have an accountant, a CPA, we're not telling you to make any changes now. And maybe you just need to get a second opinion. In fact, if you go to retirementtaxpartners.com, just click on that what if analysis, we can get you scheduled and we can provide you that complimentary tax what if analysis. And again, show you in black and white what are the strategies that you could be taking advantage of. It's well worth your time to figure out a little bit of ways to minimize the amount of taxes that you pay. And just remember, just because you got a refund doesn't mean that you're still not overpaying in taxes.